welcome to DevTech Finance. In today's video, we would be making a comparison between two of the most popular mutual funds. First one is Bluechip fund and the another one is index fund. If you like the video, do hit the like button, and if you haven't subscribed to channel yet, do hit the subscribe button. So let's start with the video. So starting with the first and foremost, the meaning of both the fund. Bluechip fund invests major proportion of amount in well-established companies. Now let me make this simpler for you. Bluechip fund is a type of mutual fund that invests major proportion, which means about more than 70% of investment amount of investors in blue-chip companies. Now what do you mean by blue-chip companies is that these are companies that are highly valued in the market. So these companies are having widely accepted products and services. These are having consistent growth over the years, large distribution network, good reputation in the market, financial stability. So all these are the features of blue chip companies which are highly valued, which is having high distribution network and widely accepted products in the market. Now blue chip fund, they invest major proportion in these companies. Now let me give you some examples of these companies, blue chip companies in India. So it can be ITC Limited, it can be HUL. When we talk about banking sector, it can be SBI and SDFC. In pharma sector, it can be Cipla, Sun Pharma. Then when we talk about automobiles, it can be Mahindra, Tata Motors. So all these are blue chip companies. And thus, you can get an idea that whenever you are investing in blue chip mutual fund, you are actually investing in stocks of these highly valued companies. Now, let us talk about index fund. So, index fund replicates the investment pattern of index. Now, again talking about stock market in India, so there are two of the most popular index. First one is Nifty 50, which is of National Stock Exchange, NSE. Second one is Sensex, which belongs to BSE, that is Bombay Stock Exchange. Now, when we talk about Sensex, it consists of about 30 actively traded stocks spread over different industries. Similarly, Nifty 50 also consists of 50 actively traded stocks from different sectors. Now, when this fund replicates the investment pattern of these index, it means that if you have invested in index mutual fund which replicates, for example, Sensex, so it would be investing the amount in the same proportion, and the stocks that would be included would be the same stocks as there are in the Sensex. So it would be replicating the same proportion, the same stocks as it is replicating a particular index. So this is the major difference between blue chip fund and index mutual fund. Now let's talk about the risk involved. So risk parameter both fall on the same pace. So risk involved in blue chip fund is moderately high, and same goes for index fund also. Now this is moderately high because major investment proportion is in equity and stock market, and thus we know that equities are more riskier funds than as compared to debt funds. So the risk involved is moderately on the higher side. But again, the advantage which I would like to mention related to blue chip fund is that it is investing in reliable and stable companies. Now this makes the risk parameter a little lower as compared to another, because you are getting a consistent return over the years. Maybe that would be a lesser return as compared to other funds, but there would be some kind of stability. Now, blue chip fund involves active fund management and high expense ratio. This is again a major difference between both the fund. Index fund involves passive fund management and low expense ratio. So let me make this a little clear for you. Index fund, because it replicates the index, it means there is nothing that fund manager has to do by their side. It would be just picking up the same stock which is there in the index that is being replicated. The same proportion would be, money amount would be invested in the same proportion as in the index. So there would be a kind of passive fund management, nothing much required by fund manager to do. And this passive fund management, which would will lead to lower expense ratio, because fund manager is not doing much about this. They are just replicating the investment proportion as in the index. So there is passive fund management, and hence there would be low expense ratio because fund manager is not getting the charges for active fund management. Now, Bluechip fund, however, consists of active fund management, and thus the expense ratio that would be involved in this fund would be on higher side. Now, this active fund management means it would be beneficial. You see that fund manager would be having a right that whenever the fund manager would feel that this particular scheme is not giving good returns, he can churn the portfolio, he can bring on new stocks, he can replace the older ones, and this is how there could be active fund management to provide a reliable growth and a certain return to the investors. So there would be more responsibility on the fund manager to provide the return percentage to the investors, which would involve active fund management, and this would lead to higher expense ratio. However, in the index fund, we already talked, it would be passive. Now, Bluechip fund and index fund both are suitable for investors with conservative risk profile and long-term investment. Now, see, this is because Bluechip fund, you are investing in all the well-established companies, so you are having a conservative risk profile. We are not talking about you are totally conservative, so you are investing in debt funds or etc. But we are talking about you wanted to invest in equity fund, but still you are little conservative. So you are investing in those equities fund which are having well-established reliable growth over the years. So this is the meaning. This is suitable for investors who want to take risk, but there should be a conservative risk profile. Now, this is again suitable for long-term investment, because when you are investing in these type of companies, you need to invest for at least 3 to 5 years, because to gain the kind of return that you expect. So about 3 to 5 years would be good, because you are not taking higher risk, you are taking moderate risk, and you are investing in established companies which would be growing consistently over the years. So you would have to make investment for longer period of time. Same goes for index fund also, because you are being conservative, you are investing in index fund which is just replicating the index. So you believe that if Sensex will grow, your fund will also grow with time. So since the index like Sensex and Nifty 50, it has been grown over the years, your fund will also be growing over the years. So you are taking a conservative risk profile, and thus you are again investing for longer time period. Now, this doesn't mean that you have certain lock-in period which you have to keep. It is totally to the investor's choice. There is no such lock-in period in Bluechip fund or index fund. If you want to withdraw your money anytime, you can go for withdrawal. There would be no lock-in period for as such. So these are open-ended scheme where you can invest and you can redeem your money. Now let's talk about some of the top Bluechip funds. So first is Axis Bluechip Fund, ICICI Prudential Bluechip Fund, Canara Robeco Bluechip Fund, SBI Bluechip Fund. If we talk about some top index funds, these are Tata Index Sensex Fund, Nippon India Index Sensex, SDFC Index Nifty 50, UTI Nifty Index Fund. So these are some of the examples of top trending Bluechip funds and index fund which you can invest in. Thank you for watching. I hope this video was useful for you. Do follow my channel and do not forget to subscribe to my channel. Thank you for all your support.